All right. So Danielle, just let me know. Do you have a view of the camera, everything rolling fine?
Yep.
All right,
Looks good.
perfect. Okay, guys. Well, today, thank you for joining us for 15 with Fallon. Last week, we talked about FHA loans, the basics of FHA loans and how they apply to you as a real estate agent, and just certain red flags that you may see out in the field that we'd like for to be able to jump in front of and possibly save time and save deals. So today, what we're going to talk about is conventional loans. Also a very popular loan type. So I think it's very important for you to have just the basics. Now, again, this is not a training in order for you to become a loan officer or an underwriter. This is just a high level view of some of the guidelines that a conventional loan has that you may see in the field, like when you're accepting offers, when you're writing offers, when you see that someone's approved for a conventional loan, what does that mean for you and your seller or your buyer? So what we're going to do is, and if you have not seen the video from the FHA loan, please go to 15withfallon.com. That's spell out 15 with Fallon, FALEN.com. Danielle's going to go ahead and put that in the chat. So you have it. So go and check out that video. You'll see that in that video, we did compare the FHA loan quite a bit to a conventional loan, and we'll do the same thing again today. You'll see a lot of comparison between the two. So what are some benefits to a conventional loan? So one of them is a higher loan limit. So the maximum loan limit for most areas in the United States is $726,200. That is the limit that you're able to finance. Now, if you would like to finance more than that, there are loan types called jumbo loans, and that's a different call for a different day, but it is possible. Now, this loan limit is actually much higher for 2023 than it was in 2022. So just to give you an idea, the loan limit in 2022 was $647,200. So it does update with the values of the properties across the country. Now, if you're in a high priced region, which we are not in Louisiana, Texas, and Mississippi, we do not have any high priced regions. That loan limit would be a little bit different, but for the sake of this call and us as local real estate professionals, the number is $726,200 for 2023. Now, conventional loans are not only for purchasing primary residences. You're also able to purchase a second home with a conventional loan or even investment properties. You can purchase multi-unit properties up to 4 units. So that is a little bit different from the FHA loan that we spoke about, which was really only for primary residences. Now, there is a very common misconception that for a conventional loan, you need to put 20% down, and that is absolutely not the case. In fact, the minimum down payment for a conventional loan is 3%. Now, not every buyer will qualify for the 3% down payment, but it is actually the minimum loan amount. Most of the time for conventional loans, you'll see 5% as the minimum down payment. But I think it's worth noting that if you do see 3% down on a contract, that is probably still very accurate. They're not trying to pull one over on you. It is possible, but if you do want to check it out, obviously talk to the lender and make sure that they qualify for that down payment. But it is possible, happens a lot. Now, for a second home or an investment property, that down payment does increase. So if they are purchasing it as maybe an investment property, you'll probably need to see a higher down payment. Now, if your buyer does want to put 20% down, there are some benefits to it. One of them is the fact that mortgage insurance will not be required. And again, if you did not get a chance to watch the mortgage insurance call that we had a couple of weeks ago, please go and check that out. We compare mortgage insurance between 4 different loan types, so you can see exactly how that's calculated, when it's needed, if it drops off. So go ahead and check that out for conventional loans. But it's also worth noting that conventional loans, even if there is mortgage insurance in the monthly note, there is no upfront mortgage insurance. So that makes it a little bit different than FHA and USDA. Now, also, if you're putting 20% down, one of the benefits is you can opt to waive your escrows. And what that means is, instead of the buyer or the borrower paying their taxes and insurance in their monthly note, they can opt to pay that on their own, where it's not included in the monthly note. Some borrowers prefer to have that option. So another cool thing about a conventional loan is that being in a community property state like we are here in Louisiana and in Texas, they do not take that into account when it comes to the spouse's debt. So as you remember, on FHA loan, because it's a government loan, even if one of the spouses is not on the loan, we still have to take their debt into account when determining the debt to income ratio. With a conventional loan, we do not, even in a community property state. Now, there are no area restrictions with a conventional loan. So there's not, some properties are eligible and some aren't, based on where they're located. Now, if you do have a buyer that is interested in purchasing a condo, this is a great loan type for them to be qualified for. Many of the other loan types are very limited on which condos would actually be eligible to be financed, but with a conventional loan, it really opens up those options. So so again, if your buyer is saying, I'm really interested in the condo, make sure they are approved for a conventional loan, or see if they can get approved for a conventional loan. It'll save you a lot of time and energy. Now, one of the main reasons that sellers usually like to see offers with conventional loans, and listing agents like to see that as well, is because a conventional loan has more flexibility when it comes to the condition than maybe some of the other government loans. So this makes it an easier loan type to finance as is properties, or maybe foreclosure properties, because some of that work that would be required to be done for some of the government loans would not actually have to be done in order to get approved for a conventional loan. So that is a common reason that a conventional loan is accepted over an FHA or a USDA loan type. Now, I'm not saying that there isn't certain restrictions. You can't have the roof falling down or electrical wires hanging out everywhere. But basically, as long as it's a minor issues that will not affect the safety or the soundness or the structural integrity of the property, usually you have a little bit more wiggle room there. But if you have a buyer that would like to get these repairs done, the conventional loan has a renovation program called the home style renovation loan. So that is an option for them. And what this allows them to do is they can actually finance the repairs or some renovations into the loan amount. That way they're not closing and then having to come out of pocket to make those renovations or repairs. So it's a good option for your buyers that maybe, like the house, but need a few things done in order to make it their own. The conventional loan is also one of the only loan types where it is possible to get an appraisal waiver. Now, this doesn't happen often or all the time, but it is possible. And this is typically based on the area value. It's for 1-unit properties and the down payment percentage. So it is possible to sometimes get an appraisal waiver, which saves time and money for your buyer. They do allow non-occupying borrowers. So if you have a buyer that's maybe having a little trouble getting approved for a conventional loan, you can see if they do have maybe a relative that would mind being a co-borrower with them, even if that relative is not planning or intending on living in the house. Conventional loans do accept that, and it's actually a very common thing to see, where a parent or a child will be a non-occupying co-borrower for their child or their parent. And then also, there are no specific or additional inspections required typically for a conventional loan. So unless there's, very obvious infestations, you won't need a WDIR pest inspection. So that is also another cool feature. So with all of the benefits of a conventional loan, of course, there are some restrictions as well. And one of the main ones that come to mind, and the reason why a lot of people or some people have a more difficult time qualifying for a conventional loan, is the fact that the credit score requirement is a little bit higher. So the absolute minimum credit score for a conventional loan is 620. So that is quite a bit higher than the FHA minimum that we talked about last week, where with 10% down, you can technically get qualified with a 500, and with 3.5% down, a 580 with a FHA loan. So a 620 is quite a bit higher. And in actuality, the pricing for a conventional loan is a little bit better around that 680 score or above. So even if you do have a 620, sometimes the pricing, the rate, and the mortgage insurance is a little bit more expensive. So usually you'll see about 660, 680. That's whenever the pricing starts to get a little bit better, and people will lean toward the conventional side. So with that being said, the DTI ratio is another limitation to the conventional loan. So what is DTI? That is the debt to income ratio. It is a percentage that takes a look at what is the percentage of debt do you have going out monthly compared to the amount of income you have coming in. With a conventional loan, the absolute max is about 49.99%. To give you a comparison, with an FHA loan, with all the same positive factors, the max is more like a 56.99. So not every borrower will qualify for the absolute max, but that kind of gives you an idea that sometimes if a borrower is qualified for more than one loan type, FHA and a conventional, sometimes they can go with a little bit higher of a purchase price by going with an FHA loan over a conventional loan. So it is very important to be able to compare those side by side. So that is one of the things that it's a little bit more limiting when it comes to the debt to income ratio. Now, it is true that many times a conventional loan will have a higher interest rate than some of the other government loans, but there is a balance to this, because with that being said, the mortgage insurance is also usually a little bit cheaper on a conventional loan, and that does depend on certain risk factors, credit score, and things of that nature. But there is a balance there. So we get really wrapped up in rate, but until you see the full picture, you can't base, what's a good loan and what's not on rate alone. There's more to it than that. And now, if you are using a conventional loan to purchase your home, or your buyer's purchasing a primary residence, there are some restrictions. Much like an FHA loan, they must move into the house within 60 days of closing, and they also must live in it for a year before they rent it out. So those guidelines for a primary residence pricing is very similar to the guidelines that FHA had. Now, seller concessions, and I know I'm running through this pretty quick, and Danielle, I swear I'm wrapping it up because I know we're hitting that 15-minute mark. But Seller concessions. And now you deal with this all the time. You'll see offers come in with seller concessions. You'll write offers asking for seller concessions. The conventional loan has a technically, for the most part, a lower percentage that's allowed. So if you remember with the FHA loan, 6% of the purchase price is allowed to be asked for or given in seller concessions. With a conventional loan, if you're putting less than 10% down, you're only able to receive up to 3% in seller concessions. That's 3% of the purchase price. And the reason why I'm telling you this is because this is something, let's say you get an offer in and a buyer is doing a 5% down conventional loan, but they're asking for an astronomical amount of seller concessions. That could be a red flag to you. So instead of going back and forth with these negotiations only to find out later when it goes to the contract goes to the lender that is not possible, this is something that you can ask them. You know, with a conventional loan, I was under the impression that there was a limitation, and then you can ask the right questions and make sure you save yourself some time and possibly some back and forth. So so that's kind of the basics that I wanted to go over with you. Some positives, some drawbacks, but you know, every loan type has its place, and every borrower has a different situation. So you have to look at all of the options in order to find out what is best for them. So again, this is a loan type that if you're dealing with a seller that wants to make no repairs and the property is maybe in not the best shape, then it may be a loan type that you'd want to consider when those offers are coming in. So I hope that gives you some guidance, some information. Now we are going to cover USDA loan on the next call. That's actually Mardi Gras, so we're not going to do it next Tuesday. We're going to do it the Tuesday after, and then you'll be able to see at that point 3 different loan types that are going to be laid out. What's the pros, what's the cons, and don't worry, we are putting together a chart for you. It's basically a quick reference guide, so you'll be able to look at those different loan types and see exactly, okay, this is the minimum down payment, you know, this is what is expected from this one. So we're going to put that together for you. That way it makes this information a little bit easier to digest. But again, hopefully that helps you out in the field. And thank you so much for joining us. Danielle, were there any questions or anything? I know I'm a little bit over. Are we good?
Just some simple ones that I think we'll be able to answer with our stuff
with
that
the
we'll
chart?
send over. So we can
Okay.
end so they can get back to their day.
Okay. Perfect. Well, thank you again for joining us, and please join us next time on 15 with Fallon. Y'all have a great rest of your week. Bye-bye.
Bye.